Hello, I'm William and this is Abraham for Propertysold.ca, and today we're going to talk about breaking your mortgage. So Abraham, the example might be someone took a 5-year mortgage and they're going to sell their home and they're going to break their mortgage and there's still 3 years left on their term.
Yeah.
Let's take people through some of the costs and some of the factors involved.
Yeah, thank you, William. It's penalties are an issue that are not easily explained or are not often explained by the banks. So what we want to think about is the type of mortgage that you did get and the penalties that will apply. For example, if you took an open mortgage, there are no penalties. It's open for that reason alone.
Okay.
If you took a closed variable or a closed fixed mortgage, that's when penalties start to get applied. And the easier the two is the closed variable. The banks will charge you a maximum of 3 months interest penalties for that. So whatever interest you would have paid over the next 3 months, that'll be your interest charge, your penalty charge.
So that's not going to be that large a number.
No, not a lot of money. We're not talking about a lot of money there, but it is a deterrent to break your mortgage. There's got to be a good reason for it. Like I said, you're selling your house, you have no choice, or for something else. Now, the closed fixed mortgage is where things get a little complicated. There's 2 calculations that are used, and the bank uses the greater of the 2. Okay, and it all depends on which one is going to be actually used and which one you're going to be charged for. It depends on the interest rate that you have and the interest rate in the marketplace. So if today's interest rates are higher than the interest rate on your current mortgage, then you're going to pay a 3 months interest penalty. That ends up being the higher calculation. And again, it's not a lot of money. We're talking a couple thousand.
For example, if you have a 4% interest rate on your mortgage and now interest rates are 6%,
yes,
don't worry about the interest rate differential. You're just going to pay 3 months.
Exactly.
Okay.
Yeah. Now, the interest rate differential gets calculated and used, because it's the higher number, when interest rates are lower in the marketplace than what you currently have.
So someone has a 5% mortgage and now it's 3% in the market.
Yeah, exactly. And the reason for that is the banks want to keep you as their client. You signed a mortgage agreement. They don't want you jumping ship and going to their competition with a lower rate.
Okay.
So they charge you more. So that calculation, basically how it works is they take your existing mortgage balance, your existing rate, and the amount of months left on your mortgage term, and they compare that with if you were to get a new mortgage today. Same balance, same term, and same today's interest rates. And whatever the difference is in the interest between the two, that's the interest rate differential. That's basically as simple as I can put it, and that's what they'll charge you. And that could be thousands. Now, they do that to keep you there, keep you from jumping ship.
So essentially, if you have a 5% mortgage and the interest rate is now 3%, you do the math and say, I can save $20,000 by breaking my mortgage.
Yeah.
You're most likely going to be paying $20,000 in fees to break your mortgage.
Yeah, the reality is it's not as much, actually. If you do the math and talk to a qualified mortgage agent, because a lot of people are breaking their 5.5% interest rates, taking today's historical lows. I did actually a deal for a client. He ended up paying $13,000 in penalties.
Okay.
Okay, it's a lot of money, guys. $13,000 in penalties. But he had a 7% interest rate. He had a large mortgage. We brought him down to a 5-year fixed at today's low rates, and he ended up saving $35,000 over the next 3 years that remained. So he tripled his money. It's like you can't put $15,000 into or $13,000 into some sort of investment certificate and get triple the money in 3 years. It's not possible, but you can when you're talking about your mortgage, because every month the mortgage payment is coming out, and there's an interest portion involved. How big is that interest portion? What are your rates now, and what could your rates be? So talk to someone that knows, and we can do the numbers. The calculations are all there on paper. It'll make sense when you see the calculations what your next step should be. Do I stay where I am, or do I put $4,000 now to save $12,000 in the future, or something like that?
Excellent.
Yeah.
Thank you very much, Abraham.
Thank you, guys.